Chapter 23. Interpretation of accounts and cash flow statements. Contents: 1. Purpose. 2. Introduction. 3. Methods in use. 4. Cash flow statements. 5. Methods of preparing cash flow statements. 6. Value added statements. 7. Chapter review. 8. Worked examples. Interpretation of accounts and cash flow statements. Purpose. After studying this chapter, readers should be able to A. Interpret accounts using standard methods, and B. Prepare cash flow. Introduction. Interpretation of accounts may be defined as the art and science of translating the figures shown in the financial statements in such a way as to reveal the strengths and weaknesses of a business and the attributable causes. Accounts have to be analyzed and interpreted for such reasons as the measure of the quality of management and how solid the capital base is. Interpretation has to be undertaken by those conversant with the language of its expression. The accounts have to be drawn up in a form which enables full appreciation of the facts to be deduced. Any financial statement can be interpreted. Consequently, management accounts, final accounts, and interim accounts lend themselves to critical analysis. Methods in use. There are three main methods in use in interpreting accounts. These are: A. Straightforward criticism or analytical review. B. Ratio analysis. C. Cash flow statements. Accounts will be perused or scrutinized by different interested persons such as the owners, that is, shareholders, creditors, employees, researchers, and bank managers. The interpreter has to consider and form conclusion on matters such as the firm's A. Profitability, B. Solvency, C. Ownership, D. Financial strength, E. Trend of economic endeavors, and F. Gearing and cover. Straightforward criticism or analytical review. Figures in respect of 2 or more years may be compared and percentage differences obtained. Comparison of figures may be undertaken in any of the following ways: A. Previous year's figures with those of the current year. B. The statistic of a period this year with those of a similar period last year. C. Figures within the year's first quarter with those of the fourth quarter of the same year. D. It may be percentage representation within the year. For example, salary expenses may be expressed as a ratio of total expenses. The above stated methods are popular with public sector organizations. Ratio analysis. Ratio analysis involves expressing one figure as a ratio or percentage of another to bring out the weakness or strength in an organization's affair. If one were to take a look at the financial statement of a government department, ministry, or corporation, the various figures disclosed would not be sufficiently revealing in terms of the strength or otherwise of the establishment for well-informed judgment to be made. Ratio analysis comes in handy here as a useful guide. Broadly speaking, basic ratios can be grouped into 4 categories as follows: A. Profitability ratios. B. Gearing ratios. C. Liquidity ratios. D. Shareholders' investment ratios. The federal, state, and local government councils use mostly liquidity ratios to measure the ease with which obligations due in the year can be met. The 3 tiers of administration operate the cash basis of accounting. However, in parastatals and government companies, where some commercial or quasi-commercial events take place, the accrual basis of accounting is in use. In view of the peculiarity of public sector activities, the following relevant ratios only are considered: vibes. A. Current ratio. The test of liquidity can be obtained from the statement of assets and liabilities and is the ratio of current assets divided by current liabilities. An organization should have enough current assets that give a promise of cash to meet short-term commitments of paying off current liabilities. As a general rule, a ratio comfortably in excess of 2 is expected. However, what is comfortable with a particular parastatal or government company may be otherwise with another. In picking the figures of current assets, all intangible assets have to be discounted. Okay. B. Quick ratio or acid test. This is the ratio which is more revealing of the solid liquidity position. It is computed thus: current assets less stock divided by current liabilities. Organizations are not able to convert all their current assets into cash quickly. For an organization or a parastatal with a fast stock turnover, a quick asset ratio can be computed. A ratio of 1 may be comfortable without suggesting that there is cash flow problem. What is important is the trend of current and quick asset ratios. From this, it can easily be ascertained whether liquidity is improving or deteriorating. It is the relative position that is far more important than the absolute figures. C. Debtors payment period. Although this index measures the average length of time it takes a corporation's debtors to pay, it is only an estimated average payment period. The formula for calculating the payment period is debtors for goods or services divided by sales, that is credit, times 365 days. The earlier debtors are encouraged to pay, the better the cash position of the board or corporation. It would be more informative to make this calculation regularly to avoid distortions. D. Creditors payment period. This is a measure of the average length of time it takes the parastatal under focus to pay its creditors. It is calculated as follows: trade or expense creditors divided by credit purchases times 365 days. E. Stock turnover period. This indicates the average number of days that items of stock are held for sale or in the store. The stock turnover period is calculated as cost of goods sold divided by opening stock plus closing stock times 2. Average stock is the average of the opening and closing stock figures. The shorter the period, the healthier the situation is in making the best use of funds. Cash flow statements. Neither the profit and loss account nor the balance sheet gives a satisfactory explanation of how a business obtains and uses its cash. The cash flow statement is very revealing of the core operations of a government, parastatal or board on the affordability or otherwise of adequate liquid resources. Data required to prepare cash flow statement. To prepare a cash flow statement, the following accounting documents are required. A. Statement of financial position at the beginning and at the end of the year. B. Statement of financial performance for the year. Key terms in cash flow statement. Cash. This comprises cash on hand and demand deposits in a bank. Cash equivalents. Cash equivalents are short-term, highly liquid investments that are readily convertible to cash and which are subject to insignificant risks of changes in value. Cash flows. These are inflows and outflows of cash and cash equivalents. Operating activities. These are the principal revenue producing activities of the enterprise. They are not investing or financing activities. Examples of operating activities. A. Cash received from the sale of goods and rendering of services. B. Received from internally generated revenue of government. C. Cash payment. D. Cash payments for overhead expenses. E. Payments of personal emoluments. F. Receipts from statutory allocations of government. Investing activities. These are the acquisition and disposals of long-term assets and other investments not included in cash equivalents. Examples of investing activities. A. Cash payments to acquire property, plant and equipment, intangible and other long-term assets. B. Cash received from the sale of property, plant and equipment, intangible and other long-term assets. C. Cash payments to acquire equity or debt instruments of other enterprises and interest in joint ventures. D. Cash received from the sale of equity and debt instruments of other enterprises and interest in joint ventures. E. Cash advances and loans made to other parties other than advances and loans made by the financial institutions. F. Cash payments to suppliers for goods and services. G. Cash payments to and on behalf of the employees. H. Cash payments for the purchase of motor vehicles. Financing activities. These are the activities which result in changes in the size and composition of equity, capital and borrowing of the enterprise. These examples are A. Cash proceeds from issuing shares and other equity instruments. B. Cash payments to the owners to acquire or redeem the enterprise's shares. C. Cash proceeds from issuing debentures, loans, bonds, mortgage, and other short or long-term borrowing. D. Cash repayment of amount borrowed. E. Cash payments by lessee for the reduction of the outstanding liability relating to a finance lease. F. Cash dividends. Methods of preparing cash flow statements. The methods used for preparing cash flow statements are A. The direct method, whereby major classes of gross cash receipts and payments are disclosed. B. The indirect method, whereby net profit or loss is adjusted for the effect of transactions of non-cash nature, depreciation or accrual of past and future operating cash receipts, payments and items of income or expenses associated with investing or financing cash flows. Chapter review. Interpretation of financial statements reviews the financial strengths and weaknesses of a business and their causes. A cash flow statement gives the details of all cash received and paid by the organization during the year. It is a good reporting statement for cash management. A value-added statement reviews the contribution of each key sector in the production of the goods and services. Both the cash flow and value-added statements are required by law to be prepared in addition to the yearly final accounts of a corporate organization or entity.